Good afternoon, everybody. We're going to get started in just a minute. We'll give everybody just a couple of minutes to join. We have people joining as we speak, and we deliberately make these for the lunch time so that we can fit them into the day. We know how exciting these can be for everybody, and we want to feed as much good information and good energy to people as we possibly can. I'm Scott Danner. I'm the CEO of Freedom Street Partners. We have lots of our different offices on the line as we speak. So we want to thank everybody for joining us today. I will introduce our special guest as we go. And I'm going to give a quick update on Freedom Street Partners because we've got a lot of offices. We're now in 7 states. And as we grow, we want to make sure that everybody knows who we are and why I run a lot of these events. We have the pleasure of really pooling our resources and bringing some of the best presenters, best of the best of Raymond James, Larry Adams here today, and that's a big one. And so we're grateful that he's going to join us. I'm just going to take a few minutes to go through a quick presentation while we start and give everybody just a quick update. Let me go ahead and share my screen here. And we are using technology, so we know that this can be fun. And it's worked. I've already done one this morning and it works good. So let's do another one. So again, I'm Scott Danner and I'm here doing our town hall meeting. We do town halls for a lot of reasons. The town hall mentality allows us to get some question and answers from our clients and our peers and the people out there that are looking to learn from what we're doing. Also, we do a town hall to make sure that you know we're out and we're here and we're available for questions. So today what we'll do is we'll do a quick update on Freedom Street Partners so everybody kind of knows who we are and what we're doing. And from there, we'll go ahead and have Larry go into his presentation, which is amazing, and I'll do a formal introduction. So I'm going to go ahead and start this. I will also tell everyone that I am at home and I'm doing the presentation from home. And so more than likely, there might be a dog barking or a doorbell ringing or something that will be fun, that will make this unique. And I will make sure that we try to keep it moving as quickly as possible. So our team is growing right here. This is our back office team. And this doesn't include what you'll go to our website and see all the team members on. But you could see that from January through January, we've grown quite precipitously. And it's just an awesome team that we're growing with. So we're very grateful. Freedom Street expansion. All right. So here we have the expansion. We have branches in Virginia, North Carolina, South Carolina, Tennessee, Georgia, Alabama, and Illinois. We have multiple offices in Virginia, our big office in Charlotte, North Carolina, and we're really grateful for all of our team members across the country now that have grown to over 38 licensed professionals. Currently, we manage over $2.1 billion of client assets, and we think that's really important because we share resources, we learn from each other, and we continue to grow. And that's allowing us to have a lot of good energy and good information that's going out to our clients. And we want to continue to get that out to you. We've really done a lot of things in the last year. We were featured in Fortune Entrepreneur and Bloomberg. Just recently, I had the honor of getting the best in state for Virginia. So we're grateful to our team and all of our clients for that. And you could see all this on the website and our social media. Living in a COVID world, I think this is extremely important just to point out. Just the team that I work with, and now there are teams in Stanton, Virginia, and Charlotte, North Carolina, and South Carolina, like we said earlier, but just my particular team did over 300 Zoom reviews and 500 phone reviews over the course of 2020. We made over 1,000 proactive client calls just in March. We had 5 virtual town halls throughout 2020 on topics from politics and policy to COVID and bringing on doctors and anything we could do to provide that outlook to the clients. We sent a quarterly newsletter to keep you informed. And I've personally done about 85 plus videos on our YouTube channel to keep things moving and information flowing. We were also able to remotely work for months and months without any client disruption. And that's a great challenge that we met and our team met. And I'm very proud of the team and all of our offices across the country that they were able to do that. So living in a COVID world has kind of been a unique thing, but we're making sure that you know behind the scenes the things that we're doing. Raymond James has made some amazing enhancements. The mobile app is enhanced with new features. DocuSign has now expanded to even more things. So we're seeing more and more availability of DocuSign, things that we couldn't do just 6 months to a year ago. And Raymond James's vault capabilities were expanded. And if you don't know what any of those things are, you're not using them on a regular basis, reach out to your individual advisor, and I'm sure they'll be happy to give you more information on those things and how they can help you. So the work continues. We will continue to be here to guide you. Today, what we want to do is really provide you information. That's our number one objective. You can see all the brands that represent Freedom Street Partners and all of our offices. And feel free to go to our website at freedomstreetpartners.com and check out any of the things that you want to check out, and follow us on YouTube or any of the other channels that exist in social media. But I'm honored today, most importantly, to bring you the information. I try to make that part super quick, so I rolled in really, really fast. But we have the Chief Investment Officer at Raymond James joining us, Larry Adam. I'm really excited to have Larry join us. He joined Raymond James in 2018 from Deutsche Bank, where he held the dual roles of Chief Investment Officer of the Americas and Global Chief Investment Strategist for Deutsche Bank Wealth Management. Larry's areas of expertise include investment strategy, asset allocation analysis, portfolio construction and implementation. And Larry has a BBA and a master's degree in business with a concentration in finance from Loyola University in Maryland, where he also serves as an adjunct professor for international finance. Larry's joining us today from his home because of bad weather, like multiple people across the country who are dealing with bad weather. Larry, thanks for making the time today to join us. We're going to go ahead and I'm going to unshare my screen so that you have the freedom to share yours and go into the presentation. But thanks again for joining us, and I will mute my line. And what we'll do is we'll let you go through your presentation, and then we'll do a little question and answers from the audience as we get through it. Thanks so much.
That's perfect. Can you see my screen? Can you guys see my screen?
We can see it. We're ready to go. Yep.
Oh, perfect. Oh, all right. Well, thank you so much for having me today. And as Scott said, we're going to go over our 10 themes for 2021. And when you look at the title of it, it's called Seeking the Thrill of Victory. And the reason we titled that is because each one of our themes is going to be paired with one of the upcoming Summer Olympic sports. And the reason we chose the Olympics is for two reasons. First of all, I think the Summer Olympics is so symbolic of how disruptive the COVID-19 was. And if you think about it, last year was the first time ever that the Summer Olympics was actually postponed. Second, if you think about when the opening ceremonies are going to occur, it's going to be on July 23rd of this year. I think that time will probably coincide with a vast majority of the population being vaccinated and most of us returning back to our normal lives. Now, when you look at this page, next page, you'll see these are our 10 themes that we're going to talk about. But before I actually get into them, I got a couple of facts for you for the Olympics. And on the left-hand side there, you see that the Summer Olympics occur once every 4 years. Tokyo is where they're going to be held this year. The U.S. will actually be hosting the Olympics in 2028. NBC and Comcast are the current broadcasting rights owners. And Coca-Cola is the longest standing sponsor. The second set of facts here on the left-hand side are the fact that there was 6.2 million mobile phones that were actually donated, melted down to create the metals that you are going to see given out. 100% of the energy is going to come from renewable sources. There's 26,000 athlete beds. Most of them are made with renewable resources. A badminton birdie is made of 16 real goose feathers. And an Olympic swimming pool holds 660,000 gallons of water. That's versus a typical residential pool that has somewhere between 13 and 15,000 gallons of water. So it's a pretty big pool. Now, how does this relate to investment strategy? Well, if you think about it, the facts here on the left-hand side are really those types of facts that you probably already knew, or you're really not all that surprised by what I told you. But the facts on the right-hand side here are those lesser known facts, facts that you'd really have to dig really deep to find out what I was talking about. And that's exactly what we want to do from an investment strategy perspective. We want to provide you not only with the facts and figures that you can find everywhere, but what we really want to do is give you those deeper insights into the markets, because that is where you actually add value to a portfolio. Now, turning to our very first theme, it's called the global synchronized recovery. And for that, we use the sport of rowing. And the reason for that is that because I believe that most governments around the world and most central banks are all rowing in the same direction to build a bridge to when we can return to our more normal lives. And if you want to look at how challenging the economy was last year, you'll see up here that these two charts up here are color-coded. And red means that we were in recession. Green means that we are in expansion. And what you notice is that last year, 19 out of the 20 largest economies in the world were in a recession. This year, it's forecasted that all 20 countries are going to have an expansion and positive GDP growth. If you look along this line right here, this shows you year by year how many countries were actually in recession. And what you see is that last year, it was a record high number. 93% of the countries across the globe were in a recession. This year, it's expected to be near a record low. Only 12% of countries are expected to be in a recession. Just to give you a little bit of a flavor of how dramatic this turnaround is going to be, last year, if you look at the global economy shrunk by 5.2%. This year, it's estimated 4.2%. This difference in economic growth from minus 5.2 to plus 4.2 is 9.4%. That is the largest rebound that we have ever seen in economic growth in the history of the world. So it is quite dramatic. If you want to look at more specifics, we believe that the U.S. economy, which was down 3.5% last year, will grow 4%. Japan, where the Olympics are going to be held, was down 5% last year. It's going to grow around 3% this year. But look at the growth in some of the emerging markets. China is going to grow around 8.4% this year. India, after being down 8.4, is growing to grow 8.8 this year. So you're seeing a big rebound across the globe. Now, why is this happening? It's because governments and central banks are all rowing in the same direction. And when it comes to government, they are across the globe going into deficits to try and support their economies. In fact, if you look at the deficits across the globe, they are at or near record high deficits. For this upcoming year, these light blue diamonds, it's expected that they will once again be significant. And in particular, this one right here, the US, this could even get much more significant and actually kind of challenge what happened last year, because this number right here does not include the potential for the rescue package that President Biden would like to get out, nor does it include the potential for a recovery package later this year. When it comes to interest rates, when we hit the pandemic, all of the major central banks around the world basically took interest rates down to zero. And I think they're going to continue to keep rates down at zero for the foreseeable future, probably 3 years. Why is that important? Because if interest rates remain low, that helps all of us when it comes to buying a home. It helps businesses finance their expansions at a low cost. And by the way, all this money that all these governments are going to issue, if rates remain low, it helps make that a lot more manageable to get this money issued. Now, when it comes to the COVID-19, well, if you look since the beginning of this year, you can see this is the beginning unfold year to date. And what you see is that it's mostly been a downtrend everywhere. But more importantly, where you've seen the most stringent lockdowns, that's where you've seen the biggest recoveries. And you can see that here from light blue to dark blue. Dark blue shows you where you've had more lockdowns and restrictions. So in North America, where we've seen a lot, you've seen a dramatic improvement. In Asia, dramatic improvement. In Europe, where 19 out of the 24 countries are either in a partial or national lockdown, you've seen a dramatic improvement. More specifically, here in the US, you have seen a tremendous improvement. Since the beginning of January, new cases are down almost 70%. The positivity rate has fallen dramatically and is on the cusp of breaking through 5%. That will be a big number, because when it breaks through 5%, most scientists view that as a level where you really are starting to get your arms around containing this virus. If you look at new hospitalizations, they're down 67%. And then even deaths have now fallen 22%, but I would forecast that that will continue to fall dramatically, because this team seems to be a laggard type of number to follow. When you look across every single state in the US, it has been a dramatic change. If I showed you this chart at the beginning of the year, every one of these states had a red line, which meant 30 days. As of this week, 100% of the states are seeing a downward trajectory across over the last 30 days. That's particularly important in the most highly populated areas, in the Northeast, the South, and the lower Midwest. The other thing that's important is that these vaccine rollouts, in my opinion, are going very strongly. 2 weeks ago, if you look at the total number of people vaccinated, it actually 2 weeks ago had already outpaced the number of people cumulatively that have caught the COVID-19. And right now, we are going to see this line continue to surge higher and higher, because the ratio of people getting vaccinated per day versus the number of new cases is around 25-1. So that is moving along very quickly. And then the one silver lining is that if you look at flu season, because of better hygiene, because of the fact that we're using masks, across the United States as of this week, every single state has a very minimal outbreak of the flu. Compare that to last year, where it was either high or very high across the entire United States. 2019, in most parts, it was considered high. So this is actually a positive for hospitalizations and people overall. The second theme is the U.S. economic recovery. I think it's going to take the shape of a triathlon, meaning it's going to be a little bit more challenging, a little bit rough waters here in the near term. I think throughout the summer, we're going to see the economy really accelerate, like a person on a bike going really fast. And then at the end of the year, I think it's going to be more sustainable. This is probably the most important chart in our whole presentation. And what it shows you is that by the time of the opening ceremony of the Olympics, there will be over 200 million people vaccinated. More important, it will include those most vulnerable, which means healthcare professionals and long-term care facilities, essential workers, and then a large portion of those aged 65 years of age and older and high risk. And the reason that's so important is because when you look at this chart, the highest mortality rate is for those people that are age 60 or older. Now, when you combine the fact that we will have over 200 million people vaccinated by the Summer Olympics, plus the 76 million what they consider healthy people, you're talking about 80% of the population being in a very good state versus this virus. And that's why when we do our probability analysis of when we think you're going to see a full reopening and us returning back to normal, we put that at right around the midpoint of this year, just prior to those Olympic opening ceremonies. Now, the trajectory of growth. For that, we like to look at something called the Dallas Fed Mobility Index. And the reason why I like that index is because it's very interesting. They have a way of somehow tapping into all of our cell phones to see how far we're moving, how long we're staying, and then when do we move next for all individuals that have cell phones. And I think that that is really one of the best ways to get a real-time indication of what's moving underneath this economy. And if you look directionally, I think it did a really good job last year. When the economy shut down, you see that these numbers plunged. As we recover through the summer into the fall, they improved. And then as we've had our most recent outbreak, you've seen it start to recover. I think you're going to see these numbers continue to struggle, kind of like a swimmer going through choppy water, trying to keep their head above the water, at least here in the near term. But as we get to the spring and summer, I think that that's when we see maximum growth, because we have all this pent-up demand, because we have reopenings taking place. That's going to lead to a rapid acceleration of growth. And then when we conclude the year, I think growth is going to be slower versus the summer, but it's going to be like a marathon runner where they have a lot more sustainability and they can keep going for the foreseeable future. So that's how we see growth unfolding throughout this year. Now, one of the big changes to be on the lookout for is that consumers are going to be the big driver of this, because when you look at this number right here, if you look at consumer checking deposits and savings deposits, it's pretty much at a record high, $15.8 trillion. Now, what we've seen, and we saw this yesterday with retail sales, is that when consumers have money, they tend to spend. Now, the one fallacy throughout this whole pandemic is that we haven't been spending. Well, the reality is we have been spending. We've been spending on goods, meaning computers, cars, appliances, household products. We have been spending. What we haven't been spending on has been on services. And you can see how much we've seen a reduction in the amount of money we spend on services. But I think as we go through this year, some of these hardest hit areas where you see food services, recreation, transportation, and accommodation, they're down 20 to 60%. I think this is where you start to see a turnaround during the second half of this year, because when we do our surveys of clients, 67% of the people now say that they want to return to restaurants by the end of this year. 58% say that they're going to get back onto a plane. And by the way, from 3 months ago, this is a significant improvement. I will bet you that when we take this survey in March, these numbers even move higher. So that'll start to see more services adding to economic growth. The third topic is fixed income. For that, we did fencing, because I think it'll be a duel. There are factors when it comes to interest rates that could force rates higher, but there are also a lot of factors that could force rates to go lower. In the end, this year, we think that the 10-year Treasury yield will end at about 1.5%. Why do we think rates will move modestly higher? Well, first of all, I think economic activity is going to improve. And by definition, when economic activity improves, interest rates tend to follow. I think you're going to see a modest uptick in inflation to where the Fed will feel better about that. But when you see inflation go higher, that tends to push interest rates slightly higher. And then when you look at yields, if you take the yield on the 10-year Treasury yield after inflation, it's the most negative that it's been since 1975. So it's not that attractive. That could force some people to start to look at other alternatives. And when you have people leaving the market, that could force rates up just a bit. In the end, with our forecast of 1.5% for the 10-year Treasury yield, that means that we could see bonds fall somewhere between 2 to 4% this year for government bonds. But then the question is, why would I want to own bonds? And the reason you want to own bonds is for diversification and to mitigate the volatility of your overall portfolio. And we've gone back and looked at the last 6 times you've seen the equity market, which are these gray diamonds, when it was down 10% or more. And look how government bonds and high quality bonds did. In all of these cases, it was either flat to positive. So again, those high quality bonds tend to mitigate some of the volatility of the overall portfolio. When it comes to the equity market, I think that earnings are going to have to do the heavy lifting this year. And the reason I say that is because I think that you're going to see earnings continue to accelerate this year. Last year, earnings were at $138. I think you're going to see it up at $175. Now, that's a 27% increase in earnings. Do I think the market's going to go up that much? No. The reason for that is that the market is forward-looking. A lot of this good news, we've already paid it forward with a lot of the good performance that we've gotten last year. So our return forecast is much more muted for this year. From today's levels, we think we'll be up somewhere between 4 to 6% in total return. But why do I still like the markets longer term? Well, first of all, we're in the first year of a bull market. Usually, bull markets tend to last about 6 years. Dividend yield on the equity market is 2%. And that's why I think that as long as interest rates remain below 2%, I think equities are still in a very attractive place versus the bond market. I think the Fed is going to remain on hold for 3 years. You don't want to fight the Fed. The Fed's going to continue to be accommodative, not raising rates for at least 3 years. 4% GDP growth is our forecast for this year. I think that it might come in better, but the point is, if you get that type of growth, that should support earnings growth. That should lift the equity markets. 5, if we get that one government, you're talking about over the last 12 months, $5 trillion, more than 25% of the size of the entire economy will have been put out there by the government for spending purposes. That should continue to increase the robustness of this recovery overall. And then 6, I think it's 6 months until we get through most of these vaccinations. That's when I think we return to normal. That becomes a tailwind for both the economy and the equity market. Now, this more robust expansion and market activity that we've seen is very consistent with history, because if you look back, the first year of a bull market tends to be the strongest. That's the easy lift, if you will. The second year, which is more of our forecast, it's going to be more muted, but that's not unusual. You still get positive performance. It's just not as great as what you get in the first year. And then the third year tends to get dialed back a little bit more. When you look at the inauguration cycle of a new president, what we've seen so far has been very consistent. In fact, if you look going back to 1928, just prior to inauguration, you do tend to see a rally. We saw that. After inauguration, the rally tends to continue on average, and that because you're in what they call the honeymoon period of the administration. But once you get to the second half of this year, historically, that's when you do start to see some volatility creeping into the market. So I would keep an eye on that. When it comes to our favorite sectors, we focus in on a sport of archery. And what you see here is that tech is the center of the bullseye. It's our favorite sector. And if you look at some of our research of our surveys that you see, 64% of our respondents said they were going to spend more on tech this year than they did last year. Think about that. That's a big number considering how much we all spent on tech last year. And I think the other thing that's important to recognize with tech is that tech is no longer just having a desktop in front of you. Technology is embedded in all parts of the economy, from telemedicine to delivery services and logistics, to artificial intelligence, to broadband. It continues to infiltrate every part of our economy and our daily lives. When it comes to our other favorite sectors that we like communication services, healthcare, consumer discretionary, and industrials. And just look at some of the anecdotal facts here. When it comes to consumer discretionary, that space is dominated by e-commerce. And in our survey, 80% of the respondents plan on spending more this year online than they did last year. So I think the visibility of earnings for that e-commerce remains extremely strong. When it comes to communication services, so streaming as an example, Disney came out less than a year ago and said they wanted to have 60 to 90 million subscribers by the end of 2024. As of last week, they had almost 95 million subscribers. They're well ahead of where they thought they could be. And when you look at telemedicine, 83% of patients plan on still using telemedicine even after the pandemic is over. And then when it comes to industrials, you're seeing a lot more businesses going to robots, automating their processes to try and become much more productive in their businesses. When it comes to ESG, that's about investing in environmental, social, and corporate governance. For that, we used surfing. And the reason for that is that surfing has been around for centuries. But this is the first time ever in an Olympics you're going to see a competitive surfing contest. Similar to ESG, ESG principles have been around for decades, but I think that we are going to see that wave continue to grow. And in fact, if you look at environmental, social, and corporate, if you just look at the headlines, even so far year to date, a very short period of time, you're seeing massive amounts of these headlines. For example, in the environment, GM says that they're only going to produce electric vehicles by 2035. If you look at the ExxonMobil, they are now going to have a subsidiary that's worth $3 billion that's going to be focused on low emission alternative energy sources and emission capture. When you look at social, you'll see a lot more of companies looking at their communities. It was no surprise that during the Olympics, Budweiser and Coca-Cola didn't do an ad. Instead of paying for an ad, they donated that money to COVID-19 relief. If you look at Starbucks, Microsoft, Amazon, they're not only donating money, they're donating people to help with the COVID response. And then when you look at corporate governance, if you look at about a month or so ago, for the first time ever, we saw our first female Black CEO of a Fortune 500 company, and that's Walgreens. Another example, NASDAQ, where all these stocks are traded, they actually put out a proposal to the Securities and Exchange Committee where they're thinking about requiring, if you want to trade on their commission, that you have to have a diverse board, which is defined as one person being a female, one person being from a minority. The significance of that is if that plan were put into place today, 75% of the companies that trade on the NASDAQ wouldn't be able to trade anymore because they wouldn't be able to meet that. So you're seeing more and more emphasis placed on that. The big difference versus the past, though, that I would tell you is that you can no longer just say you're going to do these types of things. There are actual agencies and watchdogs that are going to watch over a lot of these companies. And you can see the different agencies right here. There's a lot more companies that they're overseeing, and they're doing analysis. So for an example, if you look at the American Business Act on Climate Pledge in 2015, Bloomberg went back to everybody that signed up for that and did a study at the end of last year to see what the progress was. And these were all the things these companies said they were going to do. 27% of these companies either weren't on track or would not disclose. So my point is not necessarily the number. The point is that there are going to be more people serving as a watchdog to see what these companies are actually doing from this perspective. Number 7, international equities. For that, you have to do the gymnastics of looking at the fundamentals, and we do think it's a balancing act. For the most part, we still favor the U.S. over developed markets like Europe and Japan. If you look back, this is the U.S. performance. No matter what period you look at, the U.S. has significantly outperformed both Europe and Japan, but it's with a reason. If you look, this is the U.S. earnings. We have far and away outpaced the earnings of Japan and Europe. So I think it's well defined why we've had that outperformance. Looking into the future, I think the dynamics over time still favor the U.S. And that's because U.S. companies are more profitable. You can see that the profit margin, how much profit you get here in the U.S. is double what you get in Europe and in Japan. And if you look at the productivity of per employee of companies in the S&P 500, per employee, they generate over $900,000 in revenues. That's $300,000 more than companies generate in Europe and Japan. So between more profitability and more productivity, I continue to like the US equity market longer term. As far as emerging markets, we do like emerging markets. I think, as I mentioned earlier, with China growing at 8.4%, India growing at 8.8%. Historically, when the emerging markets are growing much more rapidly versus the developed markets, that tends to be at a period of time where emerging markets tend to outperform. And when you combine that with the fact that valuations are more attractive, we think that emerging markets should continue to do well. As far as currencies go, we think that the US dollar does not have the inside tracks, so we think that it will continue to modestly weaken. And that's primarily because of all the money printing that's taken place here in the US longer term. When it comes to commodities, we are pretty much at our target already for the year because you've seen a big rally in oil, and that's because you've seen a big increase in demand. But now that we've reached this $60 level, I think you're going to see a supply response, meaning now that oil is above this target up here of $60, that means that all of these places that produce oil here in the United States, these are their break-evens. So now they are all incentivized to produce more oil now that the oil price is higher. In April, they're going to start to produce more oil. When you start to increase the supply of something, again, that tends to put a lid ultimately on where those prices can go. So we think that oil is pretty much fairly valued in around the $60 per barrel level. And then the final topic is asset allocation. Keeping your portfolio in the fairway is very important so that you don't get into the quote hazards. And probably the best quote that I can find to describe asset allocation is, believe it or not, a quote from Eleanor Roosevelt. And her quote is that yesterday is history, tomorrow is a mystery, and today is a gift. And that's why we call it the present. And if you look at each one of these statements, they're all true when it comes to asset allocation. Yesterday is history. I mean, you've seen this quote before. Past performance may not be indicative of future performance. And when you look at this rolling performance of the S&P 500, this dark blue line, there have been time periods where the S&P 500 has been up on average 25% during a 5-year period. But there are other times where it's been down on average 8% for a 5-year period. That's a big discrepancy. So you cannot just rely on history to tell you where you're going to go in the future. Now, tomorrow is a mystery. I think last year is a classic example of that. There are events that happen that we cannot foresee, black swan events like the pandemic. But we will do everything that we can to continue to provide you with the real-time insights to help position your portfolios. Now, one thing that I do think will happen this year is that I do think that you're going to see a reduction in overall volatility versus what we experienced last year because of a lot of the things that we talked about. The fact that I think we're going to recover from the COVID-19. The economy is going to rebound. We're going to have less political tensions, particularly when it comes to trade. And the Fed's going to continue to be very supportive of the economy. But if I am wrong and volatility once again resurrects itself, that's why we want to rely on the time-tested principles of asset allocation, which include having a plan. And when you have a plan, that's when you show commitment and you have perseverance through more challenging times. And I think last year was, again, a great example where when the market fell 34%, if you would have had a knee-jerk reaction and gotten out of the market, you would not have been able to rally that we've had since those lows back last March. When you talk about asset allocation, you want to make sure you have the appropriate risk profile so you can weather the storm when it occurs. And that risk profile should include looking at your time horizon. For example, if you need that money within a year, you probably don't want to have it in the equity market that does endure a lot of volatility. And you want to have diversification among your different investments. And you do want to periodically rebalance when your portfolio gets out of alignment. Because just as an example, and again, 60-40 is just an example. We don't necessarily recommend one portfolio, but just as an example, a 60% equity, 40% bond portfolio, rebalanced when it gets out of alignment, going back to 2000, basically has the same performance as an all equity portfolio, but about half the risk. And the reason for that is because it rebalanced. It rebalanced and actually put money into the equity market when times were very challenging, after the dot-com bubble busted, during the great financial crisis, last year when the market fell. So if you rebalance, you can be a little bit more opportunistic when you do get those fall-offs in the market. And then the other point is that it is extremely difficult to try and time the market. This chart right here shows you that if you go back over the last 15 years, you've had an average annual return for the S&P 500 of 7.5%. That includes 3,777 trading days. If you missed just 10 of the best days, your performance would have gone from 7.5% down to 2.4%. You would have lost 2/3 of your performance just by missing 10 of that almost 3,800 trading days. If you missed just 20 of those 3,800 days, your performance would have gone from positive 7.5 to negative. Why do I bring this up? Because historically, a lot of those best days tend to come after those big downward movements. And if you get out during those knee-jerk reaction type of activities, you can miss out on some of these rebounds. So that's why it's so important to have a plan for your portfolio. And then the last part of this quote, and today is a gift, and that's why we call it the present. I think if you look back over the last 12 months, I think it's so important to really appreciate everything that we have and the importance of our family and our lives and all those types of things. And it's my hope that a lot of the research that we can provide you with your team of advisors, that we can take away one of your stresses of your life, and that is with your portfolio, so you can spend more time on those more important things. And with that, I do want to thank you for having me on the call, and I'm going to turn it back over and see if there's any questions.
All right, Larry, thank you so much. That was wonderful. The last couple slides he has, follow him on Twitter, on LinkedIn, and any of his social media at Raymond James as well on Twitter. Do yourself a favor and follow us on social media so you can get updated on anything that's going on out there that we have access to. Thank you to your team, Larry, and to our team, Renee, and everybody at Freedom Street Partners. Thank you all for setting this up and putting it together. Have a wonderful afternoon.